real estate started attracting serious money. So they need scale, they need large projects. So either it comes from his pocket or it comes from private equity. They will want both positions, they will want regular MIS, they will interfere in operational issues. It is a high risk, high reward game.
Welcome back to another episode of PropSutra with Balaji Rao. At PropSutra, we aim to demystify and simplify real estate. In this week's episode, we're going to understand the evolution of private equity investments in Indian real estate. We'll be talking about the discovery phase, how we peaked, and what the market stands like today. Welcome to the show, sir.
Thank you.
Today, I'd like to talk to you about private equity investments in Indian real estate. To start with setting the context, what is private equity and how is it different from other capital sources?
It looks like a simple question, but a very complicated answer in a way, because private equity, as it has slowly evolved over the years and decades, has changed, morphed quite a bit. So it started off as equity raised to make a company go private from public.
Right.
Okay. Today, it is not so much used for that purpose. So private equity is a form of capital raise from well-informed, intelligent fund managers who manage these private equity funds to bring in a sort of equity capital into an organization where it requires a scaling up of its operations, either organically or through inorganically. And it has already tapped out to a large extent the promoter equities.
Mm-hmm.
You understand? So if you think about it, when any company starts, it starts with promoter equity.
Right.
Okay. And that promoter equity slowly develops into maybe angel investors and VC funds coming in the earlier rounds.
Correct.
The next big stop is private equity, when they want some serious money for scaling up of operations or acquisitions. And then the third stop we usually say is the public equity, public markets. So in a PPP sort of a model, it starts with promoter, goes to private equity, and then goes on to the public markets for raising actual serious money. So private equity thus plugs in after your angel investors and VC funds because they'll have slightly longer time frames. Okay, unlike these people, they will have deeper pockets than promoters themselves.
Right.
And they will bring in a sort of an institutional and governance structure and framework to that business or organization, which will be useful for them when they're taking it public 5 years from them.
So it's like a precursor to going public.
In a way, that's how private equity today is playing. As I said, its genesis was the opposite.
Okay.
That's why it was called private equity, because it was equity being raised to make companies private from public and then turn it around.
So why has the switch happened?
Because I think the switch has happened more because people are realizing that to go public quickly is not very ideal, especially if it has been a very family-oriented business.
Right.
It's not very easy to become a public-facing business.
Right.
You understand? So I think private equity gives them the right balance because they will ask for a lot of accountability and transparency and sort of checks and balances without being in the public eye. Whereas in the public, when you go straight away, you're in the public eye. There is nothing which is hidden there.
Right.
So by going to the private equity players, so they have realized that they can play a role this side also.
Right.
Instead of only being on the reverse. So now, in my opinion, there are more people playing it in this way to come in before a company goes public and then take it public.
Right.
Eventually.
So in India, is this all the more popular because we are largely family-run businesses? We aren't very
See,
formalized?
India is popular because it's a capital-starved country.
Right,
Being developing and at the pace we are developing, we have capital scarcity, plain and simple, debt and equity.
right.
And whatever savings we have
Yes,
go a lot into the government and for infrastructure and for development, leaving very little sometimes for the private sector to expand. So we do need private equity, VCs, angel funds, both domestic and foreign, to plug that gap. Because a promoter will not have such deep pockets, or even if he has deep pockets, he'll want to diversify a little.
right.
So, and the public markets are very far off. You
Yeah.
need to have some sort of a scale generally,
Correct.
even if you want to be in the MSME segment. And the institutions which raise money,
Yeah,
they put a lot of their money also into, as I said, development activities rather than into companies.
Right.
Though the mutual fund industry is changing that, especially the equity mutual funds, but they go more into the public markets. They don't go into the private companies.
right.
So the bulk of the private market, which has not gone public, which needs capital, has to depend on these sort of specialized, well-informed people who will come and give them the money because they understand the business, they understand they'll be the bridge between the promoter and the public market.
Right. Over the last 2 decades, India has attracted over 80 billion in private equity investments.
In real estate.
Yes, in real estate specifically. So, what are the macro factors that have contributed to this growth, according to you?
See, real estate was a closed sector for a long time.
Right.
It opened up roughly around 2005
Yeah.
when you had automatic approval given to develop townships, commercial developments. So as soon as that came about, real estate started attracting serious money
Right.
because private equity won't come to do a singular building, for example.
Correct.
So they need to put in money which is substantial in nature. It can be maybe as little as $10 million,
Right.
but they would always want to pitch much higher
Right.
to say about $100 million and even higher. So they need scale, they need large projects. So when that got opened up for automatic approval, then naturally private equity investments started coming in. So this is a story of the last 20 years,
Right.
if you see. And as the markets develop, real estate also,
Yeah.
and the scarcity of capital is felt more and more,
Yeah.
they naturally have come in droves.
Right.
There have been periods of up and down.
Yeah.
There have been periods of what I call learning, discovery, learning, maturing, understanding the market. But I think in this 20 years, we have gone through the whole cycle almost.
Right.
And we are now more or less settling down for some serious investments and long-term investments.
Are you saying we've matured as a market now?
I think so.
Why did we peak in 2017, 2018?
In 2017-18, the peak was very natural because what happened is, as I told you, the years of discovery was, let's say, was 2005 to 2010,
Right.
when people came in and they were very go-go about it. A lot of bad investments were made because people got cheated, defrauded. And then you had the GFC, the global financial crisis in 2007-8, that had a liquidity crunch abroad, so people wanted to pull out. So it was a learning on both sides, both for the developers here
Right.
as well as for the investors from abroad.
Right.
Then it slowly started correcting itself. After all this, from 2012, it started correcting itself because I think the discovery led to the learning.
Right.
And then biggest changes were slowly in 2016 when you had the IBC Act coming in.
Correct.
Then you had the RERA slowly coming in much later. With
Yeah.
the draft RERA, everything slowly started forming.
Yeah.
Then you had the demonetization, GST, all trying to simplify, bring everything into under the light. So all this augured well for the real estate industry. It didn't go negative. So
Right.
naturally, there was a peaking of foreign investment because they said, hey, it is now coming into the open. It's a viable, vibrant sector.
Right.
If you have a long-term view, can you make money in real estate? Yes, everybody makes money. Everybody builds their money through real estate in a
Right.
way. So the peaking came when all these institutional changes started taking place. And this led to the real attraction of the sector to these private equity players around the world.
India today is described as one of the most important emerging markets in Asia. What makes us so attractive?
See, one is we are the largest economy. Among the large economies, we are the fastest growing. So we grow at a pretty good pace. If you see, our nominal growth is around usually double digits. So we are growing at a good pace. Our population is growing, so there's a demographic dividend. Geopolitically, we are very stable. Our policies are stable. We have law and order. However slow it might be, sometimes justice, it still prevails. So when you look at all these positives, I think there are very few countries in the world that can compete with us
Okay.
in safety, in stability, in the groundwork we have created
Yeah.
for a future growth and expansion.
Okay.
So most investors are fast enough, as they're very clever, to realize this. So they come in first, and the public markets and the retail investor comes in last.
Right. There's been a current slowdown in the total amount invested as well as the volume of deals. Uh, is this a market correction or just something cyclical?
See, I have a feeling it's a mix of both.
Okay.
It will be cyclical because we peaked in 2018. There was money
Right.
coming in. There was COVID. We went down. Then after COVID again, there was a bounce back. So
Yeah.
there will be this all fluctuations. Also, don't forget, we are going through a great geopolitical uncertainty at the moment with the tariff wars,
Yeah.
with the actual war between Russia and Ukraine.
Yeah.
So all this has created a lot of volatility.
Right.
Interest rates have gone up.
Yeah.
So whenever interest rates goes up again, it sucks out the liquidity from developing countries.
Right.
It goes back into the US bonds. And so all this has created a little bit of a lack of supply of PE money in a way.
Right.
So I think, to that extent, it is a bit tactical as things settle down
Right.
over the course of this year, maybe one more year, it'll bounce back. So whether it is a knee-jerk reaction to all this geopolitical uncertainty or whether it was due cyclically, that's a tougher question because I think we have had the 20 COVID
Yeah.
and we are having this 2025
Yes.
sort of a crisis.
Yeah.
So these sort of crises does tend to bring a lot of volatility and fluctuation. If you're asking me, will it stabilize? I'm sure it will stabilize in a year.
Okay. So, what are the types of private equity currently available to developers in India?
Well, that's a bit of a broad question because private equity in India are known more as AIFs, alternative investment funds. They're regulated by SEBI. Most of them are category 2, what we call,
Right.
to be technically correct. So they can have different themes.
Okay.
They can be debt private equity. That means they give you structured debt,
Okay.
not regular construction finance, but structured debt, what we call mezz finance.
Yeah.
They can be equity, so they can give you actual equity.
Right.
And they can take positions also in the market by doing forward purchases and bulk inventory. So it depends on what sort of a theme that private equity wants to. Do we have all of them at the moment? Yes. But there's a predominance of residential
Okay.
structured private equity players,
Okay.
very few commercial real estate private equity players.
Okay.
So to that extent, there's a bias towards residential, very little towards commercial, and even little towards warehousing and data centers, which is just about coming up as asset classes. So if you look at private equity, it can go asset class wise,
Okay.
it can go geographical wise, and it can go by the type of instrument, whether it is debt, equity, just a forward purchase, what sort of an instrument has been used for it.
Okay. So when we're discussing asset classes, can you help us understand what's available for residential real estate?
Well, in private equity and residential nowadays is mostly structured debt. Now, you can structure it in such a way that they come in when a project is taken on by a developer or promoter. He has put in some money, he needs more money to take the project to what we call the RERA stage,
Right.
RERA registration stage, after which only he can sell to the public.
Right.
So there is a window out there when suppose he requires 100 rupees to take it up to the RERA registration stage, he might be willing to put in 30 rupees and he look for private equity to give him 70 rupees. And with that 100 rupees, he brings it up to the RERA registration stage. And there he has a choice. He'll either start selling, in a very aggressive fashion, or he can take construction finance, which will be at a much more reasonable rate of interest as compared to private equity.
Right.
You understand? And he will use construction finance and some sort of sales volume to keep the project going till completion.
What is the typical timeline for closing a private equity investment? From meeting the builder to eventually
See,
closing?
everybody will think it's in weeks. It's never in weeks, it's in months.
Right.
So typically, a good deal should be consummated or closed out in 3 months.
Okay.
But it can drag on till 6 months.
Right.
Post 6 months, I think the deal has lost its wind. So you can drag it on and there's a chance it can close, but there's a higher chance it will not close again.
Right. Now, earlier you said we could break up investments based on their structure. How are private equity investments typically structured?
See, they're typically structured, as I said, as either debt or they would be structured as equity when they bring in equity capital.
Yeah.
Or they can even be structured as pure buyouts.
Okay.
When somebody goes and buys bulk inventory or he buys off bulk space in a commercial project.
Right.
These are the types.
When is the right time for a developer to consider bringing in private equity?
Most developers will bring in equity, as I said, when they realize to do this project they need 100, they have 30 and they need 70 more.
Right.
And that 70 cannot come from banks, NBFCs or institutions.
Right.
So either it comes from his pocket or it comes from private equity.
And what can a developer expect to change in terms of governance or day-to-day accountability once he brings on a private equity partner?
Everything changes.
Okay.
That is something which a developer should be well aware of.
Okay.
See, most people think that if you have taken money from someone, he's not answerable to that someone.
Right.
Then you need to take money from a Kabuliwala who will only come at the end of the month and take his interest and he doesn't care what you do with the money for the rest of the month.
Right.
Private equity, banks, financial institutions don't operate that way. Okay. Now, where it is debt, banks and financial institutions can be a little bit more lax. They
Right.
won't sit on your head. They might not take a board position.
Right.
Where it is equity, like private equity players, they will want board positions. They will want regular MIS. They
Right.
will interfere in operational issues if they think it is detrimental to their interests.
Right.
So you can't just walk off. And the biggest problem we have when we do it is we need to look closely at conflicts of interest.
Okay.
Like if a private equity player has invested with a company A,
Yeah.
and company A says, I want to give this contract to company B for construction,
Right.
and B is related to A, naturally the P guy's antenna will go up.
Okay. All right.
So he will tell you to float a tender and go for what we call L1, the lowest cost.
Right.
So that if A doesn't like it, then he's not mature enough for PE investments.
So how should a developer prepare himself? What should he understand before he approaches?
If he's open, transparent, doesn't have conflicts of interest, he's absolutely free to approach. But if he has all these shenanigans going on in the background and he thinks he can hoodwink a private equity investor, that will not be the correct approach because you can't hoodwink them. It's because it's not the private equity investor who does the due diligence or the MIS checking.
Okay.
He will have absolute trained people
Right.
like big audit firms and consultancy companies who will do it.
Right.
And they'll catch you in a jiffy.
Okay. How can the brand reputation of a company or a developer impact a potential deal?
See, a PE player, when he comes in, he does what we call partner due diligence.
Okay.
Partner due diligence means he wants to know everything about the partner, whether you have criminal cases against you,
Right.
Whether you're a tax evader, whether you're a politically exposed person. He needs to know the lay of the land. So in that, if you have a good brand, you have a good reputation, you have a good credit rating, then naturally he's more attracted towards you as compared to when there are all sorts of red flags all over the area.
What are the most preferred exit strategies?
See, for any PE player, he'll know what his exit is. He doesn't go in before knowing the exit.
Okay.
Correct? So the exit for him will be either you will sell and give him back the money if it's residential or even commercial, or you will take construction finance and you can give him back his money because it's more expensive.
Right.
Or when the project is completed, he'll sell off the inventory and make his money.
Right.
So he will have A, B, C, all sorts of exit plans.
All right.
And if in worst case, if a project gets delayed, then he'll look for refinancing.
Understand. Are the current exit options that are available for residential projects adequate?
See, they're never adequate for any PE player. He'll want more the merrier. Because they are not adequate, sometimes when you are in a rush to exit, you will tend to lose your returns.
Right. Well, perhaps what I'm trying to say is that with the introduction of REITs, there is a very clear exit strategy available for commercial
Yeah,
real
but you have to
estate.
understand it's only for commercial and
Right.
it's not easy to make a REIT.
Right.
It's not the Sunday you make everything into a REIT. I have one commercial project. What do? I have to go to a REIT and sell it. No?
Yes.
And he will then demand his own pound of flesh on that. No?
So, beyond capital, what should a developer seek in a PE partner?
In a PE partner,
Yes.
somebody, I think, who will help him improve his governance, somebody whom he feels he can partner with. Because most developers, I tend to believe, do not have that approach.
What do
They
you
tend to believe he's like any other banker or lender whom he has to wine, dine, and give some MIS reports, and that's the end of the story. PE is a completely different game. It's not like that.
Okay.
In a PE game, whatever it might be, he will be wanting to get into the nitty gritty of your business, the nuts and bolts of your business. If you do not want to, open up for that sort of an inspection or deliberation, you shouldn't look for PE.
So, how did the introduction of REITs in India impact investor sentiment and participation?
I think, investors and the retail investors who are participating in real estate, either because you could invest in buying a property, residential, commercial, retail, whatever you wanted, but that was big ticket size.
Right.
Or in 2007, when a few real estate companies went public, you could buy their shares.
Yeah.
But they were only the big companies.
Yeah.
Other than that, it was very difficult to really participate in real estate.
Yes.
REITs changed everything.
Okay.
It's a topic for another day for sure. But REITs changed everything because it allows a retail investor to participate in the commercial asset class. As of now, we have commercial and one retail only. Into the commercial and retail asset classes by coming at the safer end, at the shallow end, not at the deep end. You understand? So REITs are not a part of a PE story at all. PE is at the deep end. REITs are the shallow end. Where you're saying you're relatively safe because we're taking your money and investing in a ready property which is already out on lease or rent.
Right.
And we'll distribute it. It helps only because you're bringing a lot of investors together to buy a large ticket. That's all.
Over the last decade, the office sector has garnered a lion's share of the funds. Why is this asset class often touted as structurally resilient?
Okay. See, the question about the office segment is it is not as volatile to market cycles.
Okay.
You understand? Office segment is directly linked to economic growth and development. So, for a country where the growth path has always been high, and we have never really gone into a major recession of any sort over the last decade, literally, I would tend to believe that the office segment will still keep growing every year. Unlike residential, where 1 year it could have sold much more, second year it could have sold much less.
Yeah.
In the office segment, it will always be a growth. Even during COVID, the net leasing absorption was positive,
Right.
not negative. That means people still leased.
Okay.
So when there's always growth, it is a resilient sector. You
Yes.
understand? That means as long as there is growth and development in the economy, the office segment will grow. And now, due to GCCs, which are global capability centers, that growth is even more pronounced.
Right.
Correct? So it is structurally resilient. And so when PE picks up sometimes for the office segment, they are picking up the office segment, especially in the ready category, to make it ready for REITs 3-4 years down the line. So you create a fund which picks up ready properties or near ready properties, bunch it together, and then make a REIT and list it after 5 years.
Understood.
You understand? And they're pretty confident that it will do well as an asset class because the office segment will continue to attract occupiers, users,
Right.
people who will pay good rent.
Right.
You understand?
Yeah.
So that's why it's structurally resilient. Residential is also there, but residential has a lot of micro market considerations. It can have sometimes when there is a bias towards, say, right now there's a huge bias towards luxury housing.
Yes.
It might very well taper off suddenly. So somebody who's invested in luxury housing might have to wait 10 years rather than 3 years to get his money back.
Okay.
Okay. So it's not so resilient in its own way.
Okay. The retail sector has consistently underperformed on a risk adjusted basis. Why is this so?
See, the retail sector in India is still finding its feet because retail sector in India first has always been high street retail,
Right.
what we call, strip shopping, where you go shop after shop. Then came the advent of the departmental stores, correct? And your shopping arcades. Now you have the malls which have come, which are huge, and they're more environmentally or climate conditioned to give you a better experience.
Correct.
So, is shopping shifting from retail strip malls to straightaway malls, or is it really going to go skewed in the other direction, which is also fast picking up, which is e-commerce, online? Now, suppose online picks up in a big way, then physical retail is going to get impacted. Overall retail is growing.
Right.
You understand?
Yeah.
So, I think people have placed their bets evenly,
Okay.
So, there is an e-commerce which is growing very quickly
Yes.
online, okay? And they have been very, very smart about the way they've grown.
Okay.
Like if you see the fast delivery and all that,
Yes.
they're really good at it and they're so smart. You understand? So I think physical retail will have to reinvent itself, whether it's on a high street or whether it's in a mall.
Okay.
It'll have to reinvent itself with better service. Where I feel I want to buy a device,
Yeah.
but I'm not sure about it. I don't know much of the technicalities about it. I definitely need a lot of hand holding.
Right.
So then I will go to that physical retail shop,
Yeah.
and he should be in a position to do my hand holding, tell me which one it is, and then have the gumption to open the e-commerce sites and say, look, I'm still giving you at this price.
Right.
Don't think you'll get it cheaper.
So it needs to evolve the model.
He needs to evolve.
Okay.
He can neither say that, I'm the cheapest or I'm the best or I'm right around the corner. That's not good enough.
Right.
But anybody who knows the device and knows what he wants need not go to the shop anymore.
Okay.
So malls will transform themselves into more experiential centers where you're
Yeah.
going for a good time. You go for a movie, you have some grub, the kids will play in the play zone, you have a gaming arcade, you will have all that whole experience along with shops which you will browse through.
Right.
You understand? But serious shopping, which was being otherwise done earlier, on high streets,
Yeah.
in markets, in malls, that is getting impacted time and again.
Okay.
Even in a departmental store, I might go once to see what size fits me and what I like.
Right.
Next time, I might very well just do a repeat order online
Yes.
for it.
Yeah.
I might not need to go to the store, even if it is next door.
Correct. Is the current slowdown of funding in the warehousing sector due to limited opportunities?
No, I think it is limited opportunities, but also in the warehousing sector, the returns have not come. See, one has to understand in private equity, it is a high risk, high reward game that's played.
Right.
You understand? If you look at investment broadly, there are three categories, in my idea. When you want a return which is in single digits, it is a low risk category. You'll put it in time deposits or term deposits, you'll put it in government bonds, AAA rated bonds. These are the type of things.
Correct.
REITs come into that slowly. They're at
Okay.
that cusp of
Right.
low to medium at the best. They give you a good return of 9-10%, and so you're happy. When you go into a medium risk, it is in the teens.
Okay.
Like you will have something which is 10 to 20, broadly speaking, as a band, where you're taking some risk, but you'll have some collateral, like structured debt and all that. You might have personal guarantees. You will nail the borrower if he is trying to escape, but sometimes you might not succeed. So there is a medium risk and medium return, what we call.
Right.
And then you have the things which are in the 20s, high teens or 20s, as we call it, which go into the high risk, high return category.
Okay.
You're playing for big stakes.
Right.
Now, this cannot be changed. There's nobody who can tell you, look, my return is high, my risk is low.
Yes.
That's not possible in the
Yeah.
finance world. So when your return is high and your risk is high, that is where PE sits. That is where a VC fund sits. That's where an angel investor sits. Because there's high risk, high return. A junk bond sits.
Right.
You understand? So
Yes.
in that game, warehousing sometimes doesn't fit it.
Right.
Okay, because it tries to move towards the mid-teens in returns.
Understood.
As the competition grows, as more and more people went into warehousing, the costs have not gone up. The margins have not gone up for a warehouse owner or a developer to get great returns.
Okay.
You understand?
Yeah.
And in any B2B business, it's always a struggle to get opportunistic returns. In a B2C, you can get opportunistic returns when there's a boom.
Right.
In a B2B, you don't get opportunistic returns because on the other side is also a businessman who is
Correct.
negotiating hard with you, whether it's office space or warehousing space.
Right.
He's
Yes.
not just going to keel over.
Yes.
You
Yeah.
understand? So that's why there is a lesser interest in warehousing. And now there's a growing interest in data centers.
Correct. In the last decade, we've seen an emergence of Middle Eastern capital in India. How are they different from investors we saw in the early 2000s?
See, what happens when we opened up around 2005, the investors who came in were definitely, you had the investors from US, you had certain people from the continent, that is Europe, you had a lot of people from the Middle East also coming in, and from Singapore.
Right.
So this, after the GFC, naturally the American investments dried up because they had a liquidity crisis. European investments also got impacted, and Middle East started rising more and more because they found there was an opportunity out here and they could easily avail of it with lesser competition from their American or European counterparts.
Right.
Similarly, I think the government of Singapore's organizations, as well as their own institutions like GIC, Temasek, they started also increasing their exposure into Indian real estate because they understood it, they could figure out, and they were long-term investors.
Right.
Okay, so Today, if you ask me, you do have the big American players, like your Blackstone is one of the leaders by far, done very well. You have some of the European ones, but not too many. You have a lot of Middle Eastern ones,
Yes.
led by giants like Ardia, which is the Abu Dhabi Investment
Yes.
Authority. You have the things from Singapore, which is your GIC, it is your you have your Capital Land, Essendas, Temasek, you have Maple Tree. There are quite a few from this thing. But where we see today the sunrise is from the Far East and Southeast.
Okay.
So the Japanese investors and the Korean investors are showing a lot of interest. Japanese investors have made some serious commitments already.
Right.
Koreans not so far. So I would think they would be the next few people who would come in and want to do it. It's actually easier based on the time zone. There are people who would, on the lighter side, would say that based on the time zone, it will go up 1% for every 1 hour difference. So if I'm 12 hours away, I would want 12% more, he would say. Now, that's on the lighter side, but it's
Right.
actually somewhat true because if you're very far away from your investment,
Yes.
you tend to be looking at it as more risky because you can't be supervising it so well. Though you might have Singapore offices, APAC offices, India offices. So people who are closer by the periphery rim, like Middle East, Far East, Southeast, they will tend to become far more active, in my opinion, in the years to come.
Okay.
Because they can easily monitor it also.
Okay.
And their experiences have been fairly good.
Right. My closing question for today's segment is the Indian market yet to realize its full potential with regard to PE investments?
Of course, we are baby. We are just learning. See, the phases which we have gone through the last 20 years, it was a discovery phase at first. Then we went through a sort of a correction and learning phase. Now we have gone into an institutional phase where there's a good framework. So, are we just about on the threshold of maturity? Yes.
Okay.
That means it's like a young adult or a youth now wanting to explore
Right.
what it means.
Okay.
So, we are on the verge of expansion.
Right.
So it is hardly the ending or anything.
Okay. Thank you so much.
You're welcome.
That's a wrap for this week's episode. Thank you so much for tuning in. Don't forget to share your thoughts in the comment section below. Hit the bell icon for regular notifications. Don't forget to like, share, and subscribe. Until next time, thank you so much for tuning in.